guys! In this lesson, we're going to be learning about the effects of tax on elastic and inelastic demand. Why are we learning this? Because let's say that the government levied tax on alcohol or cigarettes. Is it effective? Does it reduce the number of smokers? What happens to the revenue of the cigarette company? We're going to be answering these kind of questions by looking at the effects of tax on elastic and inelastic demand. First, we're going to be looking at the effects of tax on just the normal demand. Let's look at this graph. Let's say the government levied $10 tax on alcohol. I chose this good just because it was next to me. This looks like something out of Harry Potter movie, but this is alcohol, and because lots of people are drinking nowadays, government levy tax on this kind of, what's it called? Royal salute, on this alcohol. Let's just take this as an example because it was right next to me. So let's say that alcohol costs me $50 to buy. Normally, let's say. What happens to the graph when the government levies $10 tax on the alcohol? So, what you have to do first when the question asks you that the government will levy tax is that you have to shift the supply curve to the left. Not the demand curve, but shift the supply curve. So, let's draw an imaginary supply curve. So you have to draw an imaginary supply curve. The reason is that if the suppliers want to receive the $50 that they used to receive, now they have to pay $10 to the government again. Now they have to charge the customers $60 in order to provide the same amount of alcohol they were providing before. So for these suppliers, they're going to need to raise the price to $60 in order to supply the same amount. For those suppliers who were able to supply this alcohol for $10, would have to charge $20 in order to supply the same amount. And for all the other suppliers as well, those who were able to supply at $40, for example, now they have to charge $50 and so on. So draw an imaginary supply graph that shifted to the left. Okay, like this. This is the new supply curve. So we have shifted the imaginary supply curve to the left. This is not the real supply curve, we're just imagining a new supply curve. Now what they will ask you in the question is how much price the consumers will be paying after tax and how much the suppliers will be receiving after the tax. The first step is to mark the original equilibrium so that it makes your life easier. The original equilibrium price was $50. Now look for the new equilibrium price. If you have drawn the supply curve, it has to go upwards by the amount of tax. So this amount would be $10. And you have to find the new equilibrium. So this is the new equilibrium price. So consumers will now be paying this price at new equilibrium. So this is not as much as the $60. This would be like $55. The consumers will be paying $55 after the tax, and they will also ask you what price the suppliers will receive. Now, since they're receiving $55 from the consumers, the suppliers will need to pay the $10 tax to the government. What they have left from receiving $55 is that you just subtract $10 from $55, that makes a $45. So this question frequently comes up on the FRQ. So you have levied the tax, you shift your supply curve upwards by amount of the tax, which was $10, and draw a new supply curve and just make sure that you put an equilibrium price prior to the tax, and then the new equilibrium price that you have after shifting the supply curve will be the price the consumers will be paying. So the consumers will be paying $55. Consumers are paying $55, and because $55 is price the consumers pay, the suppliers will now get $10 less, will get $45 because they would have to pay the $10 to the government after they receive price of $55 from the consumers. This is what producers get. So to answer this question, what is the price consumers pay compared to the original price? It was $50 before, but now they're paying $55 after the tax. What is the price the producers receive? The producers will receive $45. Before it was $50. For them, both $50 before the tax, but now the consumers are paying $5 more and suppliers are receiving $5 less. How much is the consumer surplus and producer surplus before the tax? You have to know something before the tax. So before the tax, it was $50, right? So consumers will be paying up to $50. So this amount here was consumer surplus, and the producer surplus used to be here. Okay, so you get it? Social surplus was the entire area of this triangle. After the tax, however, the consumer surplus would only last until where? They were paying $55. So the consumer surplus would be until here, right? And the producers will be only receiving $45. And the thing that people get confused the most is that, oh, isn't the producer surplus here? No, that's not the case. The producer surplus will never be up to here. Remember, this is the imaginary supply curve that we just drew in order to make sure that everything was easier. However, this is not the real supply curve that we want to deal with. The real supply curve that we have to deal with, and it is the real supply curve, and producer surplus will be here. It starts from the original supply curve. And what is left is this part, this rectangle. This would be the government revenue. This is the government revenue. Since the government will be taking $10, this is $10. Guys, all the spaces in between the imaginary supply curve and this original supply curve will be $10, the amount of tax. Remember that. So this is the amount of tax that they're going to get, and multiply that to the amount they are now supplying, 400 quantities, and 400 times $10 would be $4,000. That would be the government revenue. Now what is lost? It would be the deadweight loss. The deadweight loss is this much, because this part used to be in the social surplus before the tax. Now with the tax, this part isn't included anywhere. So this part, the red part, is the deadweight loss. This question really comes up frequently on the FRQ, so you have to remember this. So how much is government tax revenue? Just tax times new quantity, which is $10 times 400. How much is the consumer surplus and producer surplus after the tax? We have identified it here, consumer surplus and producer surplus. Make sure that you start your producer surplus from the original supply curve. How much is the deadweight loss? You can calculate that as well. So if that was 500, you can just 100 times 10 divided by 2, that would be the deadweight loss. If they ask you to calculate the area, but you can also be asked to just color the area as well. So, or identify an area, so that would be enough. And what you also have to know is that the tax is divided between consumers and suppliers. Consumers pay $5 of the tax, and suppliers pay the $5 of the tax. The tax, although levied on the suppliers, the tax will be divided so that consumers and producers equally pay the tax. In this case, because this is a normal demand, it's not elastic or inelastic. This is a normal demand and normal supply. So that's the way they will divide the tax into. Okay, a recap. Let's recap because this is a little bit confusing. So when you get these questions to levy a tax on some good, so you first need to identify the equilibrium price prior to the tax, and then you draw an imaginary supply curve that goes up as much as the amount of tax. So this went up $10. So I drew an imaginary curve. That's the first step. And the second step, to identify the new equilibrium price. From the new equilibrium price, you can identify the price the consumers pay. In this graph, it would be $55. Where people get confused is that they would think that, oh, it went up $10, so it will be the price consumers pay, like consumers will pay $60. That is not the case. Lots of people make mistakes on here, so just remember, this is the $60 and the new equilibrium is less than $60. You can see that. So the $55 would be the new equilibrium, and then consumers pay this price, and whatever is subtracted from the price the consumers pay would be price the producers receive. So remember that. And consumer surplus after the tax would be up to the new price, and producer surplus, remember that the producer surplus would start from where the original supply curve was, and this part is the government revenue, and this part is the deadweight loss. So if you understand this, there would be no problem solving this question in the actual test. So make sure not to make the mistakes that I told you, and hope you understand this well. And if you have any questions, leave a comment. If you think that this video was helpful, please like this video. And if you subscribe to my channel, I think it would be a great encouragement for me. So please like and subscribe. I know you're burdened by time, but it doesn't take long. And hope you have a good day. Bye bye.